Alright everyone, in this video I'm going to be breaking down some risk management strategies specifically for trading options. Keep in mind, this relates to my strategy, which involves trading options which have short expirations, which in turn makes them more volatile. You need to understand that options can be extremely lucrative, but also extremely dangerous if proper care is not taken when trading them. Unlike stock trading, where price action is linear and more predictable, option contracts trade significantly thinner volume and as such are prone to bigger price swings. For example, you could purchase an option contract which is worth $1, and after a sudden 2% drop of the underlying stock, let's say Tesla, your contract would now be worth 70 cents. That's a big drop. Now, of course, this also means if the stock itself went up 2%, then your option contract would now be worth anywhere from $1.30, maybe $2, which would be 100% gain in your option contract. But due to these wild price swings, this brings me to rule number 1. Keep size small. When entering an options contract, your baseline risk should be 30%. This means you need to put significantly less size into a position than you would if you're just trading the normal stock. Luckily though, this also means you can risk less money and still expect great returns on the proper setups. Let me give you an example of how this works. Let's say you're going to buy a stock trading at $400 and bought, let's say, $10,000 worth of stock. Now let's say your stock goes up to $440 and you decide to sell. You would make $1,000 or a 10% gain on that trade. Now, let's do the same trade, but with an options contract. Like that previous example, you think the stock will go up, so you decide to buy the $420 call options. And for this example, let's say the contract is currently trading at $1. You decide to buy 10 contracts at $1, which will cost you $1,000. Remember, each contract is worth 100 shares. Then, like the previous example, the stock goes up to $440. Let's say for this example that your option contract goes all the way up to $4, which would end up being a 400% gain. That $1,000 investment would now be worth $4,000. As you can see, in both examples, the stock went up 10%. However, with the options, you were able to net a 400% return. While trading the stock, you're only able to net a 10% return. You're also able to make more money with the options contract while putting in less money. Remember though, if the stock went against you, the option contract would rapidly decrease as well, and easily could have been worth 70 cents or even less. And this is why you must keep your size smaller than normal. In the next video, we will go over how to calculate exactly how much you can make or lose in a contract. So don't get too worried about why I chose the numbers I did in this example. These are just numbers based off previous trades I have taken that show the profit potential in these stocks. All right. Moving on to rule number 2, use limit orders only. Due to the volatile nature of options, your entries are so important here. Only use limit orders because this will ensure you get filled at the best possible price. Using market orders is the fastest way to get filled, but it's also the fastest way to get a bad fill and turn a winning trade into a losing one. Most traders who lose at trading options lose because they rushed their entries and didn't take the time to get the best price. You will see in our next couple of videos why this is so important. Rule number 3, never chase. Chasing price action is a big no-no in normal stock trading, but even more so when trading options. Wait for the ideal entry before trying to purchase the option. Otherwise, you could end up with a hefty loss on your hands, as it is very easy for the stock to turn on you and you can easily be down 30-40% if you're not careful. Rule number 4, wait for ideal setups. Trying to scalp option trades is difficult and risky and should be avoided if at all possible. You want to wait for the most ideal setups to form before you take your positions. This will ensure you are in the best possible position to take advantage of the 200 to 300% winners options can provide. I also want to reiterate that no matter how great a play may be, never ever go all in on any one trade because you never know when things may suddenly go against you. Even if your trade has a 90% success rate, it only takes that 10% play to go against you where you put in too much to wipe out your account. In regards to account sizing, this is how I'm going to allocate what percentage of my portfolio I will place in any one trade when trading options. My A+ setups. These are the setups I've tracked that I know I have an 80 to 85% win rate on. On these A+ setups, I will allocate 25% of my portfolio into these trades. On A setups, or trades where I win probably 70 to 80% of the time, I will only put about 20% of my portfolio in a given options trade. On B setups, I'll only put about 10 to 12% of my portfolio. These are setups that I've maybe win 50% of the time to 60% of the time. And finally, on C setups, I'll only allocate 1 to 5% of my entire portfolio, or honestly, I might just avoid the trade altogether because C setups really aren't that great and they don't have a high win percentage, so really there's no point to trade it at all. Now, don't worry if you're confused about what an A setup is, a B setup is, a C setup is. I'll be going in depth with what these are and what constitutes these setups when we get into the strategy module. All right, everybody, that wraps up this section on risk management. I hope you learned a lot, and I'm going to see you in the next video. Peace.